The Footprint course, Unit 10, Exhaustion High and Low. This is challenge day 17 of 30. In the following slide, we are going to focus on the art of recovery from poor performance. The focus will be on how to develop recovery skills over time.
The purpose of me going through this is I'm going to give you 3 step-for-step processes on how you can develop your own recovery skills. So think of this as drills. Okay, this is the drills I'm giving you, just like a Jordan Spieth has drills. This is your drill set that you have to go practice if you want to become better at recovery. Okay, the first one, you have to learn emotional control. Right? The only way you're ever going to become better at recovery is emotional control. Right, now the first thing to do is to understand that you can recover. Okay, most people don't think you can. Most people, the minute they take the loss, they accept the loss and they call it a day and they move on. Right, so failing to acknowledge that you can recover, right, that's one step you need to get over. Now, in terms of emotional control, what you need to be able to do is the minute you've taken a big hit, the minute you've lost a big chunk of money, you're close to stop. You need to walk away. You need to have that strength to stand up and walk away. Okay, take that 5 minutes, take that 15 minutes, because what you will notice is that very often if you do not walk away, you're going to end up digging that deep. You're going to end up digging that hole a lot deeper. Okay, you're going to end up losing more, but you're going to end up also being in a mental negative state. Okay, by sitting there, even if you don't do anything, you're not getting out of your mental state that you're currently stuck in. Okay, so the next time you need to recover, step number 1, get up and walk away for 15 minutes. Okay, go through in those 15 minutes, go through in your head the honest reasons why what happened, and you're going to find 90% of the time they were in your control. Okay, whether it was a big loss, maybe you moved to stop, maybe you kind of got into a trade because some guy on Twitter said get into a trade, whatever it may be, write it down, put it down on a piece of paper, take ownership. Right? Because once you take ownership of that, whatever caused you to take a big loss, you're going to let go of it. Okay, it's almost like if I said to you, okay, today's loss, it happened with something that's in your control. By acknowledging that it's in your control, that means you can avoid doing it next time. Okay, all of a sudden you're going to feel that burden on your shoulders lift off. So that's why we do it. That's why step 1, we walk away, we accept the loss, we take it, we say to ourselves, it's done. Now I need to move on. Now I need to get back into that mental state and move on. And that's where professional golfers are so good. Okay, they can hit one bad shot and literally 6-7 minutes later, they're back to square one. Okay, all they focused on is not what has been or what will become. They focused on what is the now. And that's the key to step number 1, emotional control. Step number 2 is self-belief. Now, a lot of people say, yes, I've got self-belief, I believe, but okay, that's not enough. So I'm going to give you another process to develop your self-belief, and it's called an opportunity sheet. Now, at the end of every single day, my trading day, what I do is I go and write down in my debrief all the opportunities that were there in the day across whatever markets. Right? And what I've tended to find is that in general, on average, okay, in a normal trading day, all things being equal, you're looking at between 5 and 8 unique tradable opportunities. Okay, opportunities that I could have executed and made good money because I understand the setup and the management and all that sort of thing. Okay, now imagine if I said to you, if you look at your trading sheet at the end of the week or your debriefs, and you go and you see that over a course of a week there were 40 opportunities that you could have made money. Just think about that for a second. Okay, because the minute you have this opportunity sheet, right, I know fine well that, bang, I've lost money, but guess what? I know on average there's going to be 5 to 8 unique opportunities today. So guess what? I may only have had 2. That means I'm likely to see 3 to 5 more opportunities. Hey, what's all the fuss about? Why am I so upset? Okay, because guess what? I'm going to have the opportunity to get it back. And that's the key to the opportunity sheet. By having the opportunity sheet, you have belief that if you were to execute in the right frame of mind, you will get that money back. And that's the key to the opportunity sheet. Try it out this week. The last one, you need a realistic approach. Okay, and this includes clip management. Now, for me in general, when I take a big hit and I need to recover, I start slow. Okay, why? Well, because there is no point in me testing my emotional ability. I know how I respond when I'm a long way down. Okay, so what I tend to do, if I'm used to risking, say, $1,000 per trade, I'm now going to risk $250 per trade. Okay, so I'm going to cut my clip. I'm going to reduce the amount I'm risking per trade. Why? Because my objective needs to be realistic. And realistically, all I need to do on that first trade is make a damn winner. That's all. Right? Equally, I need to execute that first trade as if nothing else had happened. In other words, as though it was a clean slate. What tends to happen is traders tend to execute in the same manner with the same amount of risk, and that emotion very quickly boils up, particularly if they go instantly off sides. Okay, so I reduce the clip. I then write out, if I'm, let's say, $10,000 down on the day, I go write out, five 2,000 lot increments, and I say to myself, well, here's the job. I need to get one of these clips back at a time. One $2,000, one $2,000, and all I got to do is 5 times. And then guess what? I'm back at zero. So I break it down. I create a little game for myself, little targets, so that I don't get caught thinking about, remember, the past or the future. All I focus on is the now, each individual shot. Okay, guys, that's the step-for-step process to become better at developing the skill of recovery. It's no different to a professional golfer as it is to a professional trader.
So obviously this is definitely a counter-trend strategy. Do note, however, this is if you're someone that really likes to. So obviously this is definitely a counter-trend strategy. Do note, however, this is if you're someone that really likes to go against the flow, and you're someone that likes to pick tops and bottoms, this is going to be a really great strategy for you. You'll understand why as you go through a strategy session. The whole purpose of this entire strategy is that you're going to learn it's okay to go against the market, and it's okay to stand in the way, but know when to do so. Wait for those signals, wait for the fact. So obviously this is definitely a counter-trend strategy. Do note, however, this is if you're someone that really likes to go against the flow, and you're someone that likes to pick tops and bottoms, this is going to be a really great strategy for you. You'll understand why as you go through a strategy session. The whole purpose of this entire strategy is that you're going to learn it's okay to go against the market, and it's okay to stand in the way, but know when to do so. Wait for those signals, wait for the facts. So obviously this is definitely a counter-trend strategy. Do note, however, this is if you're someone that really likes to go against the flow, and you're someone that likes to pick tops and bottoms, this is going to be a really great strategy for you. You'll understand why as you go through a strategy session. The whole purpose of this entire strategy is that you're going to learn it's okay to go against the market, and it's okay to stand in the way, but know when to do so. Wait for those signals, wait for the facts coming from the market before you attempt to do so. Okay, obviously this is a standalone strategy as well. You will notice all the various signals just with the use of the footprint, and note it's a very aggressive execution methodology required. So within the next strategy session, we are going to focus on, again, a number of principles that you would have encountered in Unit 3. But some of the standout principles for this strategy definitely include, for one, obviously exhaustion high and lows and stop runs. We're going to definitely revisit that principle quite extensively. We're also going to revisit the concept of tail auctions, as well as obviously the concept of trend, pre-context or the context heading into ultimately the exhaustion high and low. Enjoy the strategy session.
Really like the quote right at the start of the unit. Persistence is not a long race, but many short ones. Now, why this is particularly relevant to us as traders is that what I've found is that traders, for one, they want to be persistent. They've got determination. They've got time on their hands. They're willing to do whatever it takes, but they don't realize that to be persistent, it takes time. Okay, you can't just be persistent for a week and then expect to suddenly have the skill of persistence. Okay, so persistence is one of those things, like any skill set, you develop through consistent practice, through consistent application. Now, we spoke about one of the art forms of persistence, one of the spin-offs of persistence, and that is recovery. Now, if you look at one of the greatest golfers of all time, Tiger Woods, it is well known that Tiger Woods was not the best tee to green, not the best off the tee box. Okay, Tiger Woods was simply the best at recovering. He could do what very few could do. Okay, which is recover and still have the same amount of shots. So that's what it's about, guys. It's about developing the skill set of being able to recover through a lot of practice. Now, where this strategy comes from, exhaustion high and low, is very simple. Okay, I used to be, like I said to you in prior slides, I've always been very bad at going counter trend. Why? Because I, like many traders, felt a market's gone too far too fast. Market's overbought, oversold, and I'd sit there selling it and losing my shirt. Okay, but what I learned to do over time was I became slightly better at fading, but I still lost money. But then I'd have that one trade, that one opportunity where I was able to get back my losses and finish relatively close to zero. So I didn't lose anything, but more importantly, I wasn't going to lose the lesson. And that's where the strategy comes from. Okay, the art of an exhaustion high or low actually comes from persistence. It comes from recovery. It comes from recognizing some really objective facts that the market shows you in order to begin the process of fading. Okay, now the first thing to start off with is, as I said back in the Unit 3, when we do have an exhaustion high or low, the markets like to take a break. And that's the key principle for this strategy, even if you don't agree with this. Okay, I know a lot of you may be sitting there going, well, I'm not a fader. I don't like to fade markets. That's fine. Okay, but like I've said to you, in every one of these strategies, I'm not trying to just teach you a strategy. I'm trying to teach you a principle. Okay, and what I mean by that, in this simple example, if you are long, and the market suddenly has an exhaustion high or low, and it shows you one of the three variations, which I'm going to show you, make sure you're locking in profits. Okay, because if you don't, guess what? The market's going to take a break, and you're just going to give back profits. All right, so use these strategies not just for opportunity, for execution, but use them to adopt in some of your other strategies. Okay, now, the first thing to note is what can allow the market to take a break. That's what it's all about. So let's draw in a circle, a break. Okay, so if we were to draw this, the market comes up. Now the first principle we're going to pay attention to is the principle of initiative. Okay, trend and initiative. So the first thing we need to observe is that the market always needs to trend into an extreme, whether that's high or low, in order for us to get to the point of an exhaustion high and low. Okay, bear in mind, if I'm going to maybe create a simplified version of what this means, it is when a market is overbought or oversold. However, back in the day, traditionally what we would do is we would have some Bollinger Bands, and we'd simply sell on the Bollinger Band, and it would keep going against us. Eventually we'd pay up, and the market would turn back over. Okay, so Bollinger Bands were once a very good tool to observe overbought and oversold conditions. They are not a good tool for execution of overbought and oversold, and that's the crux of not just this strategy session, but the entire course. Okay, I'm not here to teach you I'm not here to teach you subjective ideas and why I think it should go up or down or what it means. I'm here to show you the fact-based information from a chart, from a market, from the principles, so that ultimately when you go back and you start trading, you're identifying objective information to execute your strategies on. Okay, that being said, one of the first things that we are going to utilize is Bollinger Bands can be very good for this strategy. Why? Well, it's simple. Okay, sometimes we might be trading other markets, okay, and we can't always see the pre-context, i.e. this is what we call the pre-context. Okay, so we can't always see this pre-context that leads to overbought and oversold conditions. So because of that, Bollinger Bands can be very useful to show us when potentially markets have reached overbought and oversold. Now what I'm going to show you in the next couple of slides, or this slide, is I'm going to show you when the information comes so that we can ultimately execute on this pre-context of overbought and oversold. Now, note in terms of market context, this could be in a balanced market, it could be in a balanced market, it could be in any kind of context. Okay, a market moving in a trend-like direction, up or down. Okay, it's very obvious, right? You're going to see a high amount of volume, a high amount of volatility. Okay, a high amount of delta in the direction. Okay, and you're going to see the cumulative delta also move in the direction. Okay, so relatively speaking, everything is going to be flashing dark colors. Okay, now we're going to have a pickup in volatility. There's going to be a lack of some sort of liquidity, so you'll see as the market either sells off or rallies, liquidity will be at a premium. Okay, and it's ultimately that concept. It's the fact that as we're trending up, no one is willing to provide an offer that makes liquidity a premium, means that we will overshoot. Okay, that's so important to understand, and it's also why Bollinger Bands miss the entire principle of what creates overbought and oversold. Okay, a Bollinger Band simply just outlines when we've moved a certain number of deviations from the mean. It fails to include the fact that liquidity premium means that if someone is stuck short, he's got to keep buying until he's filled. Okay, now no Bollinger Band can ever show you where that person is filled, but the footprint can. Okay, and that is the crux of not just the strategy session, but the entire course. We're looking for the interaction that signals out the trade opportunity. Okay, now, what can you expect from the strategy? So, initially, we have the trend. Okay, we have initiative in the market. We all know what initiative is. We all know what initiative looks like. So we have trend and initiative. Note, we'll have quite a few imbalances on the way up. Okay, and eventually something's going to happen at an extreme point. Now obviously this could be the low or the high. I'm going to talk about the high. Now, one of three things can happen at this high that signals out the exhaustion. The first one is ultimately the stops. Okay, so we know that stops will look like zeros at the extreme. So if ever you see something like this at the highest four prices of the day, 2, 3, 4, 5. If ever you see something like this, 0 times 30, 0 times 60, 0 times 120, 0, 0. Okay, so if ever you see zeros at an extreme, that tells you that we've run into an exhaustion, high or low. Why? Zeros signify to us that ultimately we have got a very aggressive, in this case, obviously buyer. Okay, so this will be at a buyer extreme, and ultimately the market's been going up and someone short has just decided to give up and have hit the market for all of these contracts. Okay, so 270, 390, 450. So someone has decided, I'm going to buy 480 contracts at market, and he takes the highest 5 prices. Okay, so that's the first extreme that can be formed if you see zeros at an extreme. Now the second kind that you can see, okay, is if we see an imbalance at the extreme. Okay, so again, we've always got the pre-context. Remember, the pre-context is trend plus initiative. Okay, we know trend has shallow pullbacks and continuation. We know there's also imbalances. We know there's a liquidity premium. So again, we assume that the pre-context is there. If we see the pre-context, whether on the footprints, as I'll show you in a minute, or we see it on the Bollinger Bands, we ultimately want to be switched on for one of the 3 variations. So an imbalance at the extreme. Now imbalance will look similar to stops, except it won't have zeros. You might have something like 10 times 50, 20 times 150, 30 times 200, and 100 times 200. Okay, so again, if you see this at an extreme, after we've had a very aggressive initiative, you know that an imbalance at an extreme signals an exhaustion point. Remember, an exhaustion point does not mean a top. Okay, an exhaustion point simply means the market has reached a point where it now needs to take a break, and there's a high probability it's going to take a break. Okay, so that's the second example. Now note, again, that's where we view the imbalances from. The last example is similar to the imbalance, except it's a high volume imbalance. Okay, and you see this in the thicker markets, like the bond markets, the E-mini S&Ps. Okay, but a high volume imbalance is simply where we churn over an aggressive amount of volume, a high relative volume. So you're going to see very dark colors. In fact, let me just draw it up here. Okay, so again, an example of going up. Maybe the S&P, you're going to see 3,000, maybe 500, 2,500, maybe 1,600. Okay, 4,000. Okay, and maybe 800. Okay, so again, we can see the imbalance, a real aggressive amount of buying. But note in this example, the aggressive buying, is being met by what? Liquidity. Okay, so in the two examples above, liquidity is at a premium. Okay, therefore, it either shows zeros, which are stops, or it shows the imbalance with low volume. If there's high volume or high liquidity being provided, you will see a high volume imbalance at the extreme. Okay, so these are the three variations of an exhaustion, high or low, that you can expect to see. Now note, one of the other ones, but again, this is something you can look into, is when we get delta divergences. Again, as I showed you in unit 4, when we spoke about the concept of bars, a bar chart for the delta, and I showed you that if all of a sudden prices are going higher, okay, but the delta is actually going in the opposite direction, all right, then in effect we are approaching an exhaustion high or low. Now note, so important, okay, is in the example of a divergence of the delta bars, you're most likely going to see that in a high volume imbalance example. Why? Because what occurs here when someone's providing liquidity is not only are they responding to the high prices, but they're equally selling a lot into the best bid. Okay, so in effect, there is more selling taking place at the best bid than there is buying occurring. Okay, that's why sometimes with these delta divergences, you'll most likely see them with the example of the high volume imbalance. Okay, so those are the examples where you can expect to see an exhaustion high or low. So it's as simple as this, guys. One, you identify the trend, the initiative, and the Bollinger Band. Once the market reaches a point of overbought, oversold, we're then looking for zeros. Okay, we're looking for an imbalance, and that imbalance can be high or low volume, or we're looking for a delta divergence. Okay, if you see one of those, it's very simple. Step one, what I am going to say to you is fading can be dangerous. Okay, it can be quite difficult as well. So what I'm going to suggest, as you'll see in the examples, if you are going to fade, let the market ping at the high, let it go off it, and when it comes back, sell it there. Okay, don't sell it on the way down, otherwise you're increasing your risk. All right, so that's your first option, to fade on a retest high. Your second option is to buy the first pullback. Okay, and this is probably the highest probability opportunity. So once it pulls back and we see the absorption, we simply get long, looking for that little bounce. And our third, those are the only opportunities, okay? So it's first and foremost the fade, but the highest probability is to buy that first pullback opportunity. Now, let's just establish why the markets take a break. I know we went over this in Unit 3, but just to understand why the markets take that break. Okay, it's simple. One is profit taking. Okay, and two is mean reversion. In other words, when a market does overextend, there are algorithms that are created to fade the market when we have reached a point that is a bit too extreme. Okay, so that's why we get that break. What I would say, as a third trade opportunity, okay, this is probably the most difficult, however, is that very often in the example of a high volume imbalance, okay, we're going to leave a bad high or a bad low. In which case, once the break is over, the markets may be pulled back, once it starts to move higher again, it gives the kind of clues you need. You then want to be looking for the extension and continuation. Now note the tip, okay? Exhaustion highs and lows are a better way to time the fading markets, okay, or taking profits. In other words, you can keep using, some of the approaches you have to fading a market, okay, but when a market shows an exhaustion high or low, like I've just showed you and like I'm going to show you in examples, that for me is the high probability time to either take profits, okay, if you are long into it or short into it, or ultimately look for a potential fade opportunity. Okay, now let's go and have a look at some of the examples, and we can see what this looks like on the footprint. So first example, note, we always start off with pre-context. Okay, we can see the imbalance, quite a strong imbalance, quite a lot of stops. The market then has a little bit of absorption, a bit of responsive buying, and suddenly the market runs into some stops. Note the 0, 0, 0, 0. Okay, market stops down, high relative volume, high relative delta, high cumulative delta. Okay, so we've got the trend phase 1. Phase 2, we're looking for effectively the signal. So we're looking for the signal, which comes in 3 versions: stops, imbalance, delta divergence. Okay, once those stops are in, like I said, we won't necessarily be able to get any of these prices. We're looking for the absorption before we buy the market and target a little bit of a bounce. Note, like I said, on the bounce, you're looking for absorption before entering shorts. Now this example, note, it came and tested one of the high volume areas that we left previously, but it didn't really give an absorption before offering lower. Okay, so it didn't really give us a short side opportunity, but definitely gave us the opportunity to be long for a little bounce before then taking out and continuing lower. Okay, so that's the first example. Now note, what I would say on the continuation example, be very cautious. Okay, simple reason is that when a market's overextended, it's overdone it's oversold in this example, to continue trending, to continue initiating, is going to require some influential participants to continue to be aggressive. Now, it's not to say they can't, of course they can, but very often, strong participants are going to allow the market, or they're going to allow the opportunity to find some liquidity before they then continue. In other words, when we sell off, and I'll talk a little bit about this in the initiative strategy, when we bounce, ultimately, the sellers are going to back off. Okay, why? Because they've run into liquidity. Okay, so if you're a big seller and you need to get an order done, you're not going to keep selling if someone's providing liquidity, and that's why we get the bounce. Then the sellers step back in. If the liquidity is there, they back off again, and that's why we get the sideways mode. Right? Sometimes what happens is we do extend, but ultimately there's still liquidity being provided, and that's what you're seeing here. Okay, so you can see it breaks down. There's still liquidity being provided. Quite a lot of passive buyers sitting there, and ultimately we can see them getting hit, and the market rotates higher again. Okay, so just be aware of that. The most profitable strategy is obviously the first pullback, and obviously if you can get a little bit of a fade opportunity on, that could be also potentially profitable. Okay, let's now have a look at another example. Okay, so again, this is a little bit of a stronger example. Again, instead of the stop outs now, we're going to see the imbalance at the high. So again, note the trend-like move, nice green candle as you can see, full-bodied candle, absorption at the low before continuation, some absorption higher, continuation, absorption higher. So the buy is real intentional here. You can see the delta picking up. You can see a nice positive delta on the day, also high relative volume. Okay, this is obviously the euro-dollar 5-minute time frame from the 20th of December. Now note, obviously, the market then creates a double imbalance, some absorption, before creating an imbalanced high. Okay, when we see that imbalanced high, we're looking for short side trades. Okay, we're also looking to buy the first pullback on absorption. Okay, so again, this is a 5-minute time frame. Probably would have been slightly easier to see on a rotational time frame, but in essence, that's where you want to be buying. Ultimately, this was quite a strong reversal. Okay, a lot of you should be looking at this and saying, well, this was quite a good inverse V reversal. Okay, we can see obviously the passive buyers stepping in, holding the market bid. Once they got token out, notice the absorption below before the extension down and the delta pickup. Okay, so again, another example of an exhaustion high or low, except this time, obviously the market rotated all the way in the opposite direction. Okay, so again, what I would say, again, in terms of risk management, how we prevent ourselves from getting caught in this, it's simple. Okay, once we're executing there on the absorption, we simply want to be looking for a retest of the highs. Okay, I'll stop right behind there. Why? Well, it's simple. We're buying on the fact that buyers should be defending this breakout zone. If they're not defending it and suddenly they start to become overwhelmed, we're simply stopping out for a relatively tight stop. Okay, another example is the oil market. This is a rotational example, and again, note the mix of an imbalance at the low as well as the stops at the low. Again, note the color, so we can see some relatively dark pink color, so a nice high volume imbalance at the low. Again, that's the first pullback. Again, no real great absorption. Market does back off before ultimately spending time in a sideways range and continuing lower. Okay, so you've got the gist of it now. Okay, it's first step, identify ultimately when there's potential for an exhaustion. When there is, be aware of one of the three imbalance, one of the exhaustion highs or lows: stops, imbalances, high or low. You can look to fade or trade the first pullback. Okay, that's our strategy session. Let's have a look now and see what it looks like on the live markets. So the first example we're going to use is the E-mini S&P, the 15th of December. It is an imbalance chart. Note, it's just a time frame based imbalance chart. So context, okay, note, we've driven from 2661 all the way to 2669. Nice positive delta on the day, 13,500 contracts. You can see on the ladder, nice high volume area here. So real aggressive intent coming from the markets. Now, note, as we break up, okay, you can see a nice imbalance here. Look at this imbalance. You've got 1, 2, 3, 4, 5, 6, 7, almost 8 prices of imbalance. Okay, so nice strong imbalance. Market begins the process of trending and auctioning higher. Now remember, as we go through this and watch this, as part of the imbalance strategy session, we always want to look to buy in front of that imbalance, so somewhere around that 26.70 and a quarter we'd be buying. But ultimately, we're looking for potentially if this market exhausts itself. So again, notice the little zero there, a little bit of an imbalance. Now what you're going to see in this example is you're going to see the market form another imbalance a little bit higher up. So every time we're going up, we're finding a little bit of liquidity, and then we're seeing another imbalance. Okay, and the market's going to continue this process until such a time as it runs into some liquidity. And that's the key on this one. Like I said to you, the three ways a market can top out: 1 is stops, 2 is an imbalance at the high, and 3 is a sell side or divergence in the delta. So note here, okay, we can see between these two prices, someone sold 3,645 versus someone buying 2,070. Okay, so in other words, what we're going to see here now is the process where there's a whole lot more selling taking place. Okay, which means that there's obviously buyers passively buying, but there's a much bigger seller providing both liquidity and requiring liquidity. Okay, and that is the third example of when a market has potentially exhausted itself. Okay, so I'm going to run this through and show you again. Notice the imbalance here, guys. Okay, 3,249 versus 3,468. A real strong imbalance. Again, we can see the imbalance taking place at the next best price. And slowly but surely, once the buyers are finished and once they recognize that a seller is looking for liquidity and taking liquidity, the market then begins the process of auctioning lower. Note the next imbalance. Okay, so, and another imbalance. Okay, so we've got a number of imbalances here taking place, and ultimately another imbalance, and you'll see a whole bunch of them if I fast forward this. So again, continued on that imbalance. And the market continues lower and lower. Okay, and that's the crux of the third type of exhaustion, high or low. It is where we get the divergence in delta, i.e. prices go higher, but the delta actually starts to go negative. Note we can see it there, minus 5,862. Again, minus 2,037. Okay, so that's the third type of divergence or exhaustion, high or low. Now, as for the example, okay, we're looking for shorts. once we identified this area with this negative delta, we were looking for some sort of absorption, so probably somewhere around the 74 halves all the way down to 74s. We saw that absorption, we'd be looking for short side trades, and we're obviously targeting that first pullback point where we will look to cut and reverse. Okay, so we can see obviously this market comes down, keeps rotating lower. Eventually we do see the market step in, absorption at the low, 1,334 contracts, and the market starts to rotate higher. Okay, that's then our first example of the the exhaustion high and low. Let's now look at another example, a more traditional example. This is in the gold market. So what I'm going to do is I'm just going to let this play through and show you what it looks like, and you can see. So what we're going to get here is a whole bunch of stops. Okay, the market's going to trigger some stops. We can see that obviously quite a bit of absorption towards the low. Like I said, if you're short already, that's awesome. The only caveat, notice where we sold off from. So we can see we sold off from 76s all the way down to 68s. Now, with the thinner markets, the reason I showed this example, with the thinner markets, it's a lot more difficult to fade the market. Okay, that's why I said to you, let it come down and retest a second time, i.e. maybe try and buy it now around the 71s, 72s, and then look for it to rotate a little bit higher. Okay, you can see the absorption there, 120, 130, 120, before the rotation high. And that's all you're looking for. The principle is what matters. Okay, the principle always remains the same. The market stops down, we've got the imbalance, we have the stops at the low, notice the zeros and the imbalance. We instantly bid up. The first bit of absorption, we look to be a buyer, and we're looking for that first pullback. On that first pullback, we're looking to be a seller. Okay, so we can see a little bit of absorption coming in there, 88, 119, before the market progresses a little bit lower. Okay, that's our examples then. Obviously, you can go through these examples from beginning to end. You can look at those exhaustion highs and lows, really just nail down the execution methodology. But we're going to talk a little bit more about that in the next couple of slides.
So another opportunity now to complete a template. After watching that strategy session, you should have a very good understanding now of what exactly an exhaustion high and low looks like. More importantly, recognize the fact that it's not necessarily a turning point in the market, and we will get into turning points in the market in one of our later strategies, but for now, at least you know whether you're someone that goes with the flow, you've got a potential for a profit take strategy, but if you're someone that likes to fade it and take advantage of small breathers in the market, this also has provided you with a great potential trade strategy. Now, if we go through obviously the observation or the strategy observation, first and foremost, we want to see this in trending only conditions for good reason. In order to get an exhaustive high and low, we need that preemptive trending move beforehand. Note this will most often occur in imbalanced markets. Okay, it's very rare that markets trend in a balanced state. They do tend to start trending from a balanced state, but most often they're trending because they're in an imbalanced mode. Now, in terms of trade location, obviously we do tend to find these on breakout days as well as trending days, and sometimes even these strategies can start from the middle of the range, but in general you're going to find that these exhaustive highs and lows, the market will be sitting on pretty much the extreme for the most of the session. Now, in terms of obviously time frame participants, do note we need large influential participants to get that trend like move. But ultimately, the exhaustive high and low doesn't come from those large time frame participants, but rather the speculative and algorithmic participants. In terms of liquidity, the reason we get the stop up is because of a lack of liquidity. So to bear in mind, if you are fading blindly without any structure, you're providing liquidity. If you wait, as I've showed you, for the three variations or the three signals, then ultimately you're fading the market with a purpose. Now, to go over those three different signals very briefly, imbalances at the high, zeros at the high, or some form of a delta divergence at the high. Okay, obviously then in terms of volatility, it will be the highest just before we make an exhaustive high and low. So markets tend to take a breather once volatility has reached a peak point. Okay, let's now move then on to the strategy identification. So once we've observed the ideal conditions for the strategy, in terms of identification, in terms of initiative responsive, we begin, we're obviously going to start off with initiative until obviously the market runs into those responsive, other time frame participants. Remember, this entire trade opportunity is about a market that's almost losing its head. It's pricing itself at very extreme prices, but at the end of the day, a market will keep moving until such a point that all the desired liquidity is filled. Okay, and that's a key premise of this trade strategy, is to understand the rule that if you're just blindly fading a market, you really are doing yourself an injustice because you cannot manage risk. Okay, if you're selling a market with a very, very unique approach, i.e. with a strategy, obviously you reduce that risk because you know where your stop is placed. Okay, so again, obviously we spoke a lot about we're going to see a lot of initiative, a lot of powerful drive in one direction or the other, until such a point we get that exhaustion high or low, at which point we get a little bit more of a response at the extremes. Okay, note it's a very aggressive price interaction, both from the initial drive and from the profit taking. Do note, I have mentioned, I've included here the three types of sort of signals or clues of an exhaustion high or low. Those are stops or zeros, an imbalance at the extreme, or a delta divergence. Now, in terms of the metrics, note volume is usually the highest at the extreme. So you're going to see that probably the darkest volumes on your summary bar, as well as on the actual footprint rotations around the extreme point. Okay, very logically, obviously, when there are stops going off and there is exhaustion, everyone just gives up. Okay, it's the fact that everyone packs it in and just takes whatever liquidity they can. That's what creates that surge of not just volume, but also delta, cumulative delta, price shift, volatility, as well as relative change. Okay, in terms of time, The reversal is immediate. It's a very quick reversal, as I showed you in the examples. It's never going to get any slower. Like I said, back in the day, maybe you had more time to respond to these exhaustion highs or lows. You have to be quick with a strategy because you've got algorithms competing with you on the same strategy. And note, in terms of the delta, highest of the exhaustion, like I said, due to liquidity premium. Cumulative delta, highest of the day at the extreme. Okay, so it's very, very typical. You're going to see either the most positive delta or the most negative delta in terms of the cumulative delta once we have that exhaustion high or low. Again, that makes sense, as once we get the stop up or that final surge of search for liquidity, you will see the nature of buying and selling interaction become very, very different. Okay, in terms of relative change, obviously, you'll see it most aggressively in terms of price. This is probably the real signal of an exhaustion high and low. The price dynamic shifts very aggressively. But we do see, obviously, relative changes in both high volume and, obviously, delta and volatility. Okay, let's now move then on and focus on the execution part of the template. So then in terms of execution and money management, obviously note, like I said, very aggressive. Very intentional. You have to be quick on this one, both on the fade as well as that first pullback. Depending on the market you're trading, obviously the thicker markets will give you slightly more time, whereas the thinner markets like your golds, your oils, your nat gas and all that, they're going to give you a lot less time. So again, just make sure you're interpreting this according to the market you're trading. Risk stop placement, very simple, guys. You have to manage a stop here. If you're fading the market, be aware you're fading the market. You keep that stop above that high. If it makes a new high or low, just get out. Don't ask questions. Make sure you're keeping automated stops, not manual stops, automated stops. Okay. In terms of the first pullback, again, we're looking for that bit of absorption. Once we see it, we get in. If the market does rotate in our favor, we simply place a stop below where that absorption was. Now, in terms of target, it's very measured. If we are fading, we're looking for something very small, something very unique, maybe a little high volume area before the explosive move, maybe even a little imbalance area as a target. If we are obviously buying that first pullback, again, don't expect an extension. Okay, be very cautious. Remember, when a market reaches that point of exhaustion, it's very unlikely it's going to continue in the trend. It's very unlikely it's going to extend on that trend at that point in time. Okay, exhausted markets take a break, which means that your targets need to be adjusted accordingly. Okay, so if you are buying a quick little pullback, just remember, keep it tight, keep the target tight as well as the stop. Okay, obviously both have got very good risk reward metrics for good reason. Do note, in terms of timing, it's exact timing. Okay, both examples we have exact timing. Price is important because we are taking smaller winners, so do just factor that in. And in terms of leveraging, we definitely don't leverage. Why? Because timing is important, and obviously it happens so quick we can't afford to leverage because we will be taking on ultimately more risk than we should be. Okay, my tip for this strategy: exhaustion highs and lows are the best way to time fading of an extended market move. Okay, if you're someone that's just found yourself fading a market and you really struggle, you know, just because you're finding all these reasons to maybe sell or buy a trending market, but it never seems to work, exhaustion highs and lows are a very good timing tool to learn how to fade, exhausted markets. Okay, guys, let's now move on to the next phase of our recommended reading. So the good news is you don't have to be a golfer to appreciate this book. Golf is not a game of perfect. Dr. Bob Rotella, he's ultimately a sports psychologist, been around a long, long time. And what I really like about this book, obviously if you have played golf or you understand the game of golf, you'll be able to relate quite a lot, which will make you appreciate it a lot more. But the principles remain the same. Okay, whether it's golf, whether it's trading, there's so many similarities between the two now. Obviously, in terms of actions, you might want to start playing golf. But ultimately, this is a book all about mental understanding and preparation. It's a fantastic book. In terms of the highlights, it's a story-like narrative encompassing troubles faced in the golf game with practical ideas. So what I really like this book, it goes through all the mental hurdles, the mental barriers that a professional golfer would have. Okay, now, why it's so brilliant is that all those same hurdles are the exact same hurdles you have as a trader. Okay, things like routine, things like practicing, things like when you step into the markets and suddenly things don't quite go according to plan, things like where you're having a bad day and you somehow have to just maintain face. All of these elements are contained in this book, and that's why it's a brilliant read. Now, some of the highlights: golf is a game of controlling what you can by understanding what can be controlled. And I think this is the real key takeaway of this book. Okay. Trading, you can only control so much. Okay, most people don't realize it. Most people seem to think you can control the outcomes. Unfortunately, you cannot. You can only control certain elements of your game, and that's what this book will highlight. It'll teach you to identify what can you control, and when you know what you can control, make damn sure that you control that 100% to the best of your ability, because everything else is out of your control. Okay, obviously then how to keep your emotions and thought focused on what matters. Again, something that's so relevant to us as traders. And lastly, practical techniques to overcome some of these difficulties. And this is the part I really like. Again, gives you a few ideas. If you're someone that maybe struggles once you start having a bad run, well, how are you going to practically get through that? Okay, great book, definite read, very short, and if you're a golfer, you'll definitely love it. Let's now move on and wrap up Unit 10. So this is the drill session then for Unit 10. We're going to start off again, go through the drill with no guided tuition, complete a template, then go through the guided tuition drill, make some notes, add some notes, think. Okay, that's the whole point of the guided tuition, is to get you to compare your thoughts before, whilst watching without the guided tuition, to comparing your thoughts after you've watched the guided tuition. Okay, once you're happy with that, go back and watch some of the videos in the slides, and then when you're happy with that, complete another template before moving on, once you're confident, to the following unit. Okay, perseverance. This whole unit was ultimately about perseverance is not a long race. It is many short races, one after the other. Okay, fantastic quote. We all seem to want to slog it out for a week or two. We lose motivation, and we think that's what perseverance is. It isn't. Okay, perseverance is a lot of short little races where we keep gaining different wisdoms, different experiences, and ultimately that leads us to the art of perseverance. Good luck, and I'll see you guys again in Unit 11.
Welcome then to strategy 5. This is the exhaustion high and low strategy. Now what I really like about this example, I kind of hope that a lot of you are left there maybe scratching your head feeling or you were a little bit uncertain as to how the strategy worked because that was the intention, guys. You know, one of the most important things when you go through this process of developing your strategies is that I've outlined very clear approaches to every one of these strategies. Now, it's so crucial that you follow that approach, okay, because that's what is underlying the strategy. That's what's giving the consistency to the strategy. It's the methodology that's ultimately not just been adopted, but that's being followed. Okay, so make sure you follow the process of each strategy when we go through them. Now, exhaustion high and low, the first most important thing is the pre-context. We need to identify a market that is entering a phase where we might see some form of an exhaustion high or low. Okay, an exhaustion high or low simply means the market needs to take some form of a break. Now we identified two key real signals that can show us that the market has formed one of these exhaustion highs and lows, and that comes down to either some zeros at the low or an imbalance at the low. Those were the two key identifiers that we could visually see for an auction high or low to have formed. Now, what's wonderful about this example is that you're going to see neither. Okay, you're not going to see zeros at the low, you're not going to see a stop run with the zeros, and you're not going to see an imbalance either at the low. Okay, what you're going to see is a low being formed on a great deal of absorption, and that's what we're seeing here in this example. We can see the market's extended itself on the candlestick chart. We've done a good move from 88s down to 30s. We've identified maybe this market has entered a point of oversold conditions. We can see the high volume as well as the delta, all showing us that this market is potentially reaching an exhausted point. Okay, what the market doesn't show us, what this footprint doesn't show us, is that real clue, that real signal that actually this is an exhaustion high or low. Okay, it simply just runs into a pocket position. We can see a great deal of pocket positioning, high volume, a lot of absorption took place from 30s up to 35s. And ultimately, once that fill was done, we then started to see the market rotate higher. So straight away, again, I hope a lot of you did this drill. You went through it. You were really trying. Maybe you even watched it a second time, trying to find those zeros, trying to find that imbalance. Couldn't find it, and you were left a bit confused, because that then means that you were following the process. Okay, not to worry if you did, find yourself thinking, okay, well, there was a lot of absorption here, therefore it's time to go long. That's perfectly understandable. The most important thing is that you go and make a note of this in your template. Okay, that's what the template is there for. It's there to go and identify when you executing on the parameters outlaid for you, or when you're just executing because you're recreating the potential for an exhaustion high or low. Okay, now that being said, a little bit of caveat, okay? It is not to say, okay, this was a very good example. The market did now turn around and bounce quite aggressively. So it's not to say that in future you don't begin to observe that we get some really good turnarounds when a market's exhausted itself with a signal that looks very similar to what we've seen below. Okay, so again, make a note of that. If you find that going forward with the strategy that you tend to observe the market doing this quite often before turning around, well, then you have a very powerful strategy play in hand. Okay, and that's ultimately the purpose then of the template, of you coming back and forward between your examples and completing the template. Alright, for the example, obviously this does then continue to rotate higher. Do remember, obviously, an exhausted high or low does not signal the end of a trend. It simply just signals the market taking a breather. Okay, that then brings us then to the end of the strategy session, and we are now going to move into Unit 11.